Hit it.
It's Friday, May 21st, 2021, episode 132. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we welcome to the show View from the Peak author and all-around terrific guy, Paul Krake. We have a fascinating discussion about his career at some of the most prestigious hedge funds and his unique view at how the macro landscape will unfold in coming years. After that, in Talking Charts, Patrick does his very best to convince us that monsters are real and that, yes, technical analysis does indeed work.
This week in trading history, we look back at the Buttonwood Agreement, and we end with their segments of No Stupid Questions and Skin in the Game. And folks, we might even drink some beers along the way, so stick around. We got a great show. Lena, hop on. What beer are we drinking today?
So today, we're drinking one of the classics, Pabst Blue Ribbon Original.
Like we go from drinking pineapple flavored like sours to the PBR.
The good old PBR.
This is, isn't this what the hipsters drink?
That's right.
Yeah.
I used to love this beer in my 20s because I thought it was really cool.
So you were a hipster when you were in your 20s?
I tried. It was a phase. I don't really have much to say about the beer since everybody probably knows, but there's a couple of fun facts. So in 2017, they had a 99 can case of PBR sold in Quebec only.
No, that's funny.
I mean, I think they started making them available in certain states after that year, but in 2017 for the holidays, it was only available in Quebec for 99 beer case of PBR that you could buy for, I think it was like $100.
That's hilarious.
And then
99 beers in a case. And when we make our bets, we're going to start betting 99.
That's right. We should put that
and
in
on
there.
the pack it says family pack, so it's a good time.
Beer for the whole family.
And then in another fun fact, in 2017, PBR teamed up with some winterwear brand to make a Pabst branded jacket that doubles as a beer cooler called the Sixer. The garb turns wearers into mobile 12-pack with 11 pockets, making the 12th can in your hand.
Wow.
Yeah, that's my only chance of having a 12-pack or a 6-pack.
There you go. All right, before we get to the disclaimer, Lena, just a quick announcement on the Miami Huddle Muddle.
Yeah.
By the way, is it true that you're coming?
Well, if I can pass the COVID test, I will be there.
Nice.
Hopefully I'll pass.
Nice. All right, so tell people how they can register for those who want to join us.
Hopefully everybody's already signed up, subscribed to our weekly email. So if you have been subscribed to the email, you will get a separate email today, Saturday, and there's a capacity limit. So you do have to sign up right away. And if you are on the guest list, you will be sent another email with all the details of where it's happening and when.
Nice.
This is fancy.
Yes.
It is.
You guys have a guest list.
Yeah, but it's still free.
It's still free to attend. It's just there's a capacity limit, so we want to make sure that we're following the rules.
All right. So give us some side effects, Kevin.
Well, before we do that, why don't you tell people the time and place? Not the place, the time.
We can't.
The date.
It's on June 11th in Miami, and it's going to be downtown Miami.
So there we go. Okay, let me do the side effects. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include vaccinated teeny Vixie, beer and Brent backwardation, and then this one's kind of funny, uranium erections. And then the funny thing is, big thanks to Akash Badania who said these, but then he actually put... Sorry, Lena, after that one. Like it would be offensive somehow to Lena. He probably figured you're the only woman listening to the show. It's our great pleasure to welcome to the show Paul Krake from View from the Peak. And Paul is a man of many talents, a man that has done many things, and we're going to have the great privilege of going through his career. And so welcome to the show, Paul.
Kevin, thanks so much.
I've been looking forward to this for a long time. Why don't you tell us a little bit about yourself? Obviously, you have an accent, and although I guessed wrong, you know, everyone else probably can recognize right away that you're from Australia.
That's true, Kevin. But I may have done some good things, but I've never done great things because I'm not the Canadian who invented the pineapple pizza for a start, which, again, you talked about that a few weeks ago, and I found that absolutely intriguing.
Yeah. Do you like it? Because I know a lot of the world is very mad at us for the pineapple pizza.
I don't mind the pineapple pizza, which makes me a bit of a heathen in some circles.
For sure.
But I do laugh at these sort of things because I think of the Canadians inventing the pineapple pizza is the same as coffee snobbery in Italy and Australia. In Australia, if you don't grow it, you shouldn't have a view on it.
That's right. You're absolutely right. I always, on a trading desk, it used to be people would say no fish, no fruit. And so a lot of the times that was kind of the rules. So on the trading desk, we never got the pineapple pizza. It was kind of a little bit of that masculine no pineapple pizza. But I actually love the thing, and I know Lena's a fan. And I think Patrick is trying to suffering from his masculinity. He doesn't. He won't admit to liking it, but I think he does. So why don't you tell us a little bit about yourself? You grew up in Australia. How did you find your way into the investment industry?
So, I was lucky enough to out of college to go work at Macquarie Bank originally, which was, as people like to tell me at the time, it was the Morgan Stanley, Goldman Sachs of Australia. And when I left college, you either went if you were going down that path, you were lucky enough to either to work at Macquarie or Bankers Trust back then.
Okay.
And I was luckier still when my boss at the time decided to put me up for a job at Goldman in Hong Kong. And at that time, Macquarie was a little bit of a farm feeder system for Goldman at that stage. And there was a slew of Aussies working for working for Goldman in Asia. And I was lucky enough to be in Asia with Goldman through the Asian crisis, where I had a bit of a front row seat to some guys who are now, household names. And if I've been lucky in one sense is that, I've been able to work with some pretty incredible speculative investors over the years. And, the FX desk at Goldman in Hong Kong had Mike Novogratz, Adam Levinson, Tim Throsby, who was the former head of the Barclays Investment Bank, was running equity trading. Mike Daffy, who's just left Goldman after 25 years, was running sales. I mean, the quality of people was spectacular, and you learn the macro business. Firsthand. A, if you work with those sort of quality people, but B, if you happen to be thrown into the deep end in the midst of the Asian crisis, which still has left me with lessons and scars, and scars to this day.
So was that mid-90s you went to, was it Hong Kong? Was that where you were?
Mid-90s in Hong Kong. And I was on the equity derivative desk, and, we, like guys like Raoul Powell was working on, it was my counterpart in London. We just had this fantastic crew. And, in 1999, I was lucky enough to when I left Goldman to go to New York, because I was offered a job with More Capital on their Asia desk, and that sort of got me to into the hedge fund side of things, which again sort of rinse and repeat. I've been lucky enough to work with some incredible people. You're sitting down. A morning meeting with Lewis Bacon is an extraordinary experience.
Wow.
The weekly trader get together with Bruce Kovner is equally as impressive. It reminds me of one story with Bruce back in 2003 at the beat lows of the Nikkei. Beat lows. I'd done a trip to Japan, and went saw the BOJ and the MOF, and Kevin, I thought I was the business, right? I'd met everybody, right? And I've come back and I am bullish Nikkei. Right. I think it was just under around 8,000, and I'm so constructive, and I got to present at the weekly meeting. I've got every chart you could think of. I've got everything, and I have been rehearsing this in front of the mirror for a week and a half. Right? And and I've shown people on the desk, and there's some other senior guys, and they love what I've done. And I've sat down, and I've done the presentation, 30 minutes in total. And Bruce just looks at me and says, Pull up the chart of the Nikkei, and my heart just dropped because I knew what was coming. And he says, "Paul, describe that chart to me." And I said, Bruce, it goes from top left to bottom right. Paul, why would I buy anything that goes from top left to bottom right?
Was that the end?
That was the end. It made it over. Done. And that was Bruce. And what made Bruce the most impressive investor that I've ever had the pleasure of working with is intellectually without peer, right? Just so rigorous with all his research, yet everything, all his trading was chart based. If he didn't have chart support, and by the way, you never gave him a chart with a moving average on it. You never gave him a chart with a line on it, right? If things were going up, he would buy them. If things were going down, they would sell them. And of course, the academic intellectual framework around the thesis played a vital role, but you didn't get in and you didn't get out without the chart telling you to do so.
That's fascinating. So do you consider him like you're the kind of the best investor that you've had the privilege of trading with?
Yeah, he is. He was brilliant, and because of that, because there was just, if anyone deserved to have a level of intellectual arrogance, it was him, and the charts kept him honest, and the charts kept him grounded, and it was there've been plenty of guys who are very lucky investors. There are guys who are have their moment in the sun. Consistently, he was the most impressive person I've ever worked with.
One of the things when you read, I guess it's Market Wizards when he's interviewed, and he says, what I'm really looking for is a consensus that the market is not confirming. That's a little bit of wisdom that I've always found to be, next level in terms of the thinking, and also the way he articulates it is that you kind of know that, like so for example, the way I interpret that is like everyone is bullish yet the stock market's not going up.
Yeah, but then, and we'll put it that way, this will get it on his radar screen, right? And if you think the life cycle of a trade is 0, where is no one's thinking about it, to 10, where everyone's got it on,
right?
You only have to live in 3 through 6. Right. And, all the great macro investors, the great trading investors over the years, not just macro, but if you're a speculative equity investor, you live in this world as well. If you can get it 3 through 6, i.e. get it when it's starting to move, right, and you get out when it's starting to get excessive. I mean, that's the realm these great guys live in, because they never go too early and they never hold too long.
That's fascinating. So they don't bother with all the kind of hero calls at the bottom or the hero calls at the top, as evidenced by your fact that you were trying to do a hero call on the Nikkei.
Total hero call. Now, did it end up being right? Yes, but would I have been stopped out? Or did I get stopped out in the meantime by going too early? Yes. Right. And the picking tops and bottoms. We'll put it this way: that's the realm of venture capital, and the reason venture capitalists can do that, right, that sort of thing, is because they don't have mark-to-market accounting. If you have mark-to-market accounting, you can't pick tops and bottoms.
Well, that's a fascinating way of looking at it. So let's go back actually to the Asian crisis, because you're sitting there, you're a young guy, and you're on this desk, and geez, the stuff must have just been flying. That's really getting thrown into the fire. Was there anything that really struck you as like, let's just put it this way, something that you were sure was the one way that ended up being another way, like in terms of a revelation about how the world works?
I think that the big thing is, and I think if there's going to be one theme through this conversation, I think it's humility is the theme. And humility comes down to the point is knowing that, having the confidence to know that an event is going to play out, but not having the precision or the insight to know when it's going to play out, right? So what does that mean? The dirty little secret about FX during the Asian crisis was that there were a lot of household name macro hedge funds who lost a lot of money in 1998, for example, right? And won't name the firm, but there was one firm in particular that, well, there was a bunch of them that said the Thai baht's going to devalue in July of 1997. The baht's going to devalue next week, and they do a 1 week forward and pay 1% absolute for it. and then then it wouldn't devalue, and they do it again, and they do it again, and they do it again, and by the time you've done it 6 times, you're down 6% on the capital invested, right? Where you had other guys in particular who just said, I don't know when this is going to happen, right? But I will happily pay 15% on the 1 year forward, knowing which were ridiculous prices by any stretch of the imagination. But history will tell me that if this peg does break, it's not moving 15, it's moving 40, right? That is a level of maturity and humility where, look, at the end of the day, you are when you're fighting central banks, for example, they put up a good fight. They go hard, right? And so getting the exact timing right of when something is going to occur, it's next to impossible, right? So what do? If you're confident in a very negative outcome, you suck up the carry. You go as long as you think is reasonably possible to make sure the event happens within your time frame, and you sit back and watch. Wow. And that's one of the big lessons that I learned, is that the macro business is an incredibly difficult one today, because you've got to. It's not just about being right; you've got to be right in the right time frame. Right. And for me, that's the great skill in macro is about timing, and if you can take timing out of the equation, you should increase your Sharpe ratios dramatically.
Right. So you're moving from Asia to New York City, and there you work for Muir, you work for Caxton, and eventually you go off on your own.
Yep. So in 2004, I got a call from Dwight Anderson, who was at Osprey at the time, and he was setting up a fund of funds called Wingspan, and he seeded 6 funds at the time, and I was the macro fund. It was predominantly commodity guys he was doing. So guys like Danny Masters was running money for Dwight at that stage, and a bunch of others, and I ran my own firm, and Kevin, it was one of those things which I am so glad I did. It made me realize, more importantly, the things that I'm good at and the things that I'm not good at. It makes you appreciate that that ego. To quote the book, that ego is the enemy. And it's to run the business of a hedge fund with all the marketing meetings, and at that time you had things like SEC registration issues and all that sort of stuff. It's a really hard thing to do, and there's a reason why the business model is so good, because very, very few people get it right.
I think that a lot of people that are sitting there and just kind of watching, with envious kind of eyes, they don't realize how much of the actual business of running a hedge fund is more than just picking the right stocks or picking the right trades. There's the whole marketing aspect. There's the whole running the business. And then finally, there's the actual investment portion. And those other two, the first two, end up, from everyone that I've spoken to that's gone off and done this on their own, it ends up being that they're a time suck that really hurts the third.
Yeah, Kevin. Look, at the end of the day, compare it to a Silicon Valley startup, right? There is no way that you would launch a tech company, and the principal would retain 95% of the equity, right? But that's the standard MO of a hedge fund, where what you should be doing is giving up 30% of the equity to make sure that you have the best chief operating officer you can find, the best general counsel you can find, the best head of marketing you can find, and to build the team. I'm always bewildered that the hedge fund universe doesn't raise capital for the management companies, right? Because if you were going to start a hedge fund today, I think you've got, realistically, no change, if you're going to do it properly, out of $5 million of upfront costs for the management company to really do it properly.
Right.
And again, you're competing in that institutional world, and spending $5 million of upfront capital to get things started and established, I think is perfectly conceivable. All right. But yet that's not the model that the hedge fund world embraces. And I think that the reason that you have legitimately a decade of underperformance in the hedge fund space, I think has a lot to do with the poor quality of the infrastructure that's put together at the start.
Paul, it sounds like you've got a new business venture there.
Oh God, no! Those days are done.
Okay, so you go run your own hedge fund, and it ends up being that your timing isn't great. You during the great financial crisis, you close that, and you start writing.
I start writing. So I for full disclosure, I got divorced around the same time, and you can't run a fund and get divorced at the same time, right?
Yeah.
And
So can I just interrupt here, Paul? I got a story to tell you of a very famous fund of funds investor, and he had a rule that when a principal at a fund got divorced, he would liquidate the fund. Just because for exactly what you say, you're going through this life change. It's very difficult. And he said that, performance always suffers. And he decided that he had long been an investor in David Einhorn's, Greenlight. And he decided that no, David was good enough that he was going to be able to, handle this. And he made an exception. And he said, a couple of years later, he said, I should never make exceptions.
Yeah, it's fair because the emotional roller coaster you go through, and I'm sure there's plenty of people listening to this who've unfortunately been through divorce, and it's just a tragic destructor of capital. You need to take realistically, and all the friends of mine that have been through it, you need to take 2 years for yourself, right? At the end of the day, last time I looked, the New York Stock Exchange is not going to go away. Right, the FX markets aren't going away, and opportunities will always exist. So, if your passion is running money, take the 2 years off, look after yourself, look after your kids, do the stuff that you need to do, and it will always be there. But effectively, that's what I did, and I was looking for what I wanted to do, and I took the time away to really just assess what I wanted to do. And someone quite well, Louis Gove and I had a conversation, and Louis said, well, basically implied, why don't you write for a living? And obviously he didn't see me as a threat to his company, but so I started just putting some notes together. I had an illustrious 14-week career at Jefferies when I took a job to pay for some bills, and realized very quickly that was not for the head of sales for Asia at Jefferies was not for me. Right. Left that, and I've had View from the Peak ever since.
That's awesome. So what was it like putting pen to paper? Had you enjoyed writing before?
No, it's not. I'd never thought about it. And it's funny. I had a call with a woman I know this morning who I have done her creative writing course, right? Just because I'm a big believer that there's nothing worse than boring research, and I'm trying to find ways to make the research more interesting, right? Okay. And I think I'm now at that famous 10,000 hours of writing, where I think I now can. I know how to get away with, when you've got nothing really to say, I know how to say it. Okay. I can get away with sort of making something boring interesting. And again, I think the 10,000 hours thing is really applicable. It's not, writing's now not a chore for me. Look, I committed to Sundays 10 years ago, which was one of the great mistakes of my life, because I spend 6 hours on a Sunday early writing now. But it's, apart from the odd writer's block, which everybody gets, I actually do enjoy it. And I get a lot out of it because it's my way of collecting thoughts.
Well, I love reading your stuff, and I would have thought you were a natural writer. It comes, obviously your 10,000 hours is really paying off. As an aside, I actually, when I was starting to write and I was doing my letter, I forced myself to write every day because I had heard about this guy on the internet that decided to write a song every week. And no matter how bad the song was, he was just going to write this song and put it up there every week. And I thought to myself, that's the way to get better, is just to force yourself to write. And so I wrote every day, rain or shine, and whether there was nothing to write about. And I tell you, it sure focused the mind to have to come up with something every day.
But it's a wonderful habit. And look, there's if you write 1,500 words every day for 50 days, you've got 75,000 words, which is a novel. Now, it's probably a bloody awful novel, but it's still a novel, right? So, again, I go back and forth on writing a book and all this sort of stuff as well, just because that's obviously a big commitment. But no, it's a way. I look at it through a very selfish lens, which it's my way to collect thoughts. And look, this yourself. I mean, with an institutional business and speaking to, luckily the people I speak to, you get to reverse broker a lot of things, right? Because you get a lot of thinking from a lot of smart people. And my Sunday report, to some extent, is a collation of all of that.
Okay, so let's talk a little bit about your views, what you're seeing out there, and obviously you have extensive dealings in Asia, and your background is there, so you seem to have kind of probably a more kind of focused lens on that portion of the world as compared to a lot of other writers.
Yeah, I do. And Kev, I think about it this way. I look at, when I sort of meet someone for the first time, I do something very, very, what I call very imminent, like the here and now, and then I focus on sort of the extremely long-term things. So, one of the problems that you and I have, and writers have in general, if you build a business over time, is you have this collection of clients that have varying time frames, right? So you just can't go out and say, I'm bullish bonds, right? Because when you've got a guy who's got a 3-week view and a guy who's got a 3-year view, they're reading the same document, right? So not every report you write is going to be applicable to the same people. So when you meet someone for the first time, you have to ask them what their time frame is, right? What's their investment horizon, right? So, for example, I could ask someone today, and they could, say, what's my view on treasuries, for example. So it's very, very time frame dependent, right? So if you ask me now on a 3-month view, do I think yields are going up a bit? Yes, I do. In 18 months' time, do I think that yields are probably lower than where they are today? Yes, I do. Do I think in 3 years' time that the United States has a negative 10-year yield? Yes, I do. So to say you're bullish or bearish on fixed income is borderline dangerous without the signpost that is the time frame around it, right? So you've got to determine sort of what someone's horizon is, because when the way I sort of look at the world is very much through what I call mega thematics, right? And those mega thematics are things like China, climate, fintech and digital currency going forward, demographics, inflation, digitization, AI, and things like biomedical as well. Now, you can probably, if you want to think about mega thematics, you can put crypto in its own bucket, you can put education in its own bucket. But generally speaking, you've got to look at the world through those themes, right? Now, if you're a speculative trader who's got a 3-week view, you really don't give a shit about demographics, right? It's not really what you think about, right? But the issues of China may be very, very influential to what you do on a 3-week view, and it's funny looking at the influence of China in general. I don't think you've seen a better example of a complete misunderstanding of how China works than what you saw this week with Bitcoin, right? So I have spoken to so many people, Kevin, in the last year who have told me time and time again that the Chinese not only won't ban Bitcoin, that they can't ban Bitcoin, right? That this is the population is going to demand it. There's too many government officials making too much corrupt money out of it, and they just can't ban it. Kev, pardon my language, the Chinese Communist Party can do whatever the fuck it wants.
For sure. That's all I was thinking.
Number one goal of the Communist Party is preservation of the Communist Party, and they can do whatever they want. And again, I don't know if China is going to ban Bitcoin. I have some very, very smart people that I know who think that Bitcoin and cryptocurrency will have a role, not pari passu with the digital RMB and DCEP, but it can be on the same train tracks as Alipay and WeChat Pay, for example. There's arguments to be made like that. But what I do know is that to not factor in a complete Chinese ban of all cryptocurrency when looking at the model, when looking at how you are investing in Bitcoin, Ethereum, etc., is borderline reckless, right? And I think that the reason that a middle-aged white guy who doesn't speak Mandarin has a very, very good China-related research business is because people don't get and understand China even to this day. And there are so many misconceptions about how China operates. And frankly, that's the opportunity set for many, right? So, I often joke that Lehman Brothers would still exist if it was a Chinese company, right? Because the reason that China's been able to avoid a financial crisis in the last 10 years is not because it has a sustainable credit model. If you put it through a Western credit lens, it doesn't work. But China isn't a Western credit lens because it doesn't have mark-to-market accounting, right? Lehman Brothers would still exist if we didn't have mark-to-market accounting.
Right. You're
Right?
absolutely right.
And these are just some of the misconceptions that are out there.
So let's kind of dig in there a little bit. What are the other misconceptions about China, and what do investors get most wrong? Like, I know I sit there and I stare at the FinTwit gurus that are always telling us to short the Hong Kong dollar because the peg's gonna break and all this stuff, and it just seems to be time and time again. There's all sorts of bearish kind of narratives that gain traction, and they make for a sexy story. But I really wonder, like how much they're costing their investors with those trades.
Yeah, and we're not going to mention Kyle Bass by name, are we? Oh, sorry, did that slip out? It's like, I have to get this off my chest. The perma bears, and China's a great example where there are lots of perma bears. It's just ridiculous, right? So to say, consistently, world's going to end, world's going to end, world's going to end, world's going to end. 2015 occurs, and you have the unraveling of the bursting of the equity bubble and the reweighting of the CFET basket and the move towards the renminbi going into the IMF special drawing rights basket, right? So September of 2015, China's a disaster, and these guys are all doing victory laps, right? And then it goes back to normal. So I think that. Here are the two big misconceptions, right? Let me word it slightly differently. The two great foreign policy mistakes that the United States has made in the last 40 years relating to China is, one, to believe that China could not be economically successful without having political freedoms, right? And the second one was, I think it was 1997, Bill Clinton said that controlling the internet is like nailing Jello to a wall. China nailed Jello to a wall. Right, and the notion still that China is, for example, that China is somehow expansionist. Right, China hasn't had a conflict with a neighbor since 1979. Yet China somehow has regional, global expansionary ambitions. Now, yes, they're making the reclaimed islands and the like. They're being aggressive in the South China Sea, but that is more for national security, national internal security metrics, right? But the one big one where I will talk about a little bit, if you wouldn't mind, is about the internationalization of the renminbi. And there is a notion, I wouldn't call it the consensus, but there's certainly an audience of people out there who believe that the Chinese are determined to make the renminbi a rival to rival dollar hegemony, right? And I think there's nothing further from the truth in that statement, i.e. that the great China internally can control everything, right? It can control narrative, it can shut down the internet, it can control its people through force and coercion. It can manipulate markets, it can manipulate prices, it can control everything domestically, right? Now, the greatest threat that still gets brought up in Chinese official circles, time and time again, was the Japanese occupation, in the Second World War, right? So the Chinese have learnt from that experience that they can control everything internally, but when you start to elevate risk, when you introduce external the potential for volatility via external forces, right? So that's the reason that you have to custody Chinese bonds domestically, right? Anyone who's tried to trade Chinese bonds via the China Bond Connect knows how big a pain it is to do with that, right? And the reason for that is that that China wants to have all its bonds basically custodied on shore, right? Because what's the common theme in an emerging market crisis? It's foreigners selling your debt, right? I've predicted, Kevin, 15 of the last zero economic busts in Japan in the last 30 years, right? And the reason there haven't been any predominantly is through one factor and one factor alone, and that's because 95% of JGBs are held domestically. Right. And the Chinese look at that Japanese model, which has remarkable similarities in terms of an effective one party state, an incredibly debt focused, rigorous industrial policy, lots and lots of similarities, and realize that if you don't give foreigners access to your bonds, then the chances of you having a currency crisis are very, very slim. And I think that for me that's a big misconception. China wants to get away from its dependency on the dollar, right? It doesn't want to have a situation where its banks go under sanction, or they face embargoes, or they end up being short dollars because the US doesn't allow them to access SWIFT or whatever other problem could face. So they want to move away from that. But I don't really think the Chinese have that much interest in being the global trade currency, because to be that, you've got to have, there's a lot of consequences to that.
Right. And so now, having this view, how does this kind of permeate through your investment decisions? Is there a trade in there?
I think there's structural trades around China, right? So, and again, let's go back to the sort of the things that people don't appreciate, right? When the US Congress gets to the edge about calling China a currency manipulator and then doesn't because they fear it might piss them off, China's the greatest currency manipulator on the planet, right? Now, the renminbi might be driven by supply and demand dynamics on a day-to-day basis, even a week-to-week basis. But at the end of the day, the renminbi goes where the PBOC wants it to go, right? So, it's very difficult, for example, for Starbucks from time to time to do a $50 million FX trade out of China back to Seattle, right? Because, from time to time, China will make it just more difficult for currency to leave the country, right? Despite everything we hear about China's opening up, it still has a very, very closed capital account, right?
Okay.
So, I think that the ability to sort of take money in and out of China remains incredibly difficult, which means that when you look at China, you've got to always look at it through this internal lens, right? So, for example, if you look at the 20 companies that are going to transform China, one of the themes that we've found through doing interviews of these companies and the like has been that the market believes that the likes of Alibaba, Tencent, Baidu, etc., are going to want to expand internationally, and the reality is that these companies aren't thinking as aggressively about international expansion as what other people think they will be, right? So, at the end of the day, to think about China as a self-sustaining, somewhat inward-looking economy, which will be the world's biggest economy at some stage in the next decade, don't think about Alibaba and what it can do in Indonesia or India. Don't think about NIO selling cars in Europe. Think about what that can do domestically, because this is an economy that is, from a population standpoint, is 4 times that of the United States, and over the course of the next 30 years, it will dwarf the US economy just simply because of the population base.
Right. Now, one of the things that I believe that you're kind of focusing on is that even though it seems that many investment banks are following these stocks, the Alibabas and all the likes of those, you would contend that the amount of research is actually somewhat limited, would you not?
Oh, it's god awful. Yeah, it's not very good. Well, look, there's just a misunderstanding of China anyway, right? And I think that it's not very good because of the misconceptions. I have. If we've got to spare 3 hours, I'll talk about how I think sort of investment research, the quality of investment research globally is really quite poor because it's far too short dated in the way it views the world, right? So should we be thinking about trying to get YouTube's earning contribution to Google right this quarter, or trying to find the next AWS?
Right.
And that's the way I think about it. But no, I think that the problem that people have is, and this is valid, that they don't trust Chinese research because they don't trust Chinese data, right? Even though the amount of data that is available in China, both through alternate sources and traditional sources, is simply amazing. It's just there's so much of it and covers so many different things that the ability to get data is tremendous, but there is a skepticism about the quality of research, and the trouble you face right now, and the reason that our series has been well received, is because people can't travel to China,
Right.
and it's still one of those things where you got to kick the tires. Right,
Yeah.
you got to be on the ground, and that's going to be a problem for the next several years because I think that I don't see travel opening up between the US and China for at least 18 months.
Why don't you tell people? You just mentioned your series, but why don't you tell people what that is?
Right. So we have a series called US China series, which was originally, when we started it back in 2019, was an effort just to add value to our View from the Peak clients. And it started off as a 20-person breakfast, 50-person lunch type thing, where I would interview a China expert on a topic, right? So I'd get someone like Sam Sachs from the Yale Law School, who was one of my original, has been such a great friend of ours, and we talk about cybersecurity. And obviously, when COVID hit, we'd just done a 400-person conference in Seattle, and obviously that all went to zero. So we decided to put it online, and we put it online and offer it free to the public to get them to generally participate, because at the time we were worried about being seen as a sort of an expert network, right? Anyway, so we've made it available to the public, and all of a sudden we've had 5,000 people who have attended events over the last 11 months, and it's growing like a weed. And we do interviews with with these 20 transformative companies. I'm doing something on China's space ambitions next Tuesday, which will be fascinating. We just cover a lot. Anything that's interesting, we'll find a speaker to talk about it.
So, we got a lot more to talk about in terms of the market, but while we're on this topic, why don't you just tell people the landing page where they can go learn more about your company and these series?
Yeah, sure. So it's uschinaseries.com, and it's got a full list of the events that we've got up there. I think I've got 5 or 6 events up there already, but I think we've got 12 events scheduled for June, and heading, hopefully, if I can find someone to help me with this, going to daily content by the end of the summer.
Well, that's fascinating. Okay, so I'm not going to let you off the hook, though. You talked about your mega themes, and China was one of them, and we've gone through that. But there was a whole list of other ones: climate, FinTwit, inflation, demographics, AI. Which one do you want to hit next?
Mate, so let's talk about because I'm jealous about. So David Rosenberg is a bit of an idol of mine, and I'm a structural disinflationary guy, right?
You think you were going to get off the hook after you said negative 10-year yield within a couple of years? I was like, oh, we're going to have to talk about that. I was just waiting, but okay, let's go for it.
Okay, so the 36,000-foot view on inflation is simply as follows. And I'll start with a question. Name one example of a Western economy in the last 50 years that has seen inflation by printing money.
There hasn't been. Yeah, I would agree with that. Yep. Nope.
There's been none. Now, whilst you can make an argument that if you're expanding the monetary base effectively through the fiscal mechanism, right, printing money and actually just then handing it out to people who are in the bottom 50% of income earners who have a very high propensity to spend, that potentially could be inflationary. And look, you're going to see, as the base effects are noted now, now, you're seeing inflation for, you'll see inflation for 2 or 3, probably for a quarter or two, right? But after that, we're still in a world where, that the world is, I think, remarkably stable, i.e. that, long-term growth is remarkably consistent in Japan, in Europe, in the US. It's been on this 15-year glide path lower in Japan, in China. And come next year, we're going to face a world where 2020, we lost a lot of growth. 2021, we caught that back. And then 2022, we're going to go back to long-term trend. But we're going back to long-term trend with the backdrop of a fiscal deficit of 20% of GDP, right? And for me, that's where it gets very, very problematic because, again, a Republican administration is not going, a Republican-controlled House which is a distinct possibility in 2022, is going to take the fiscal deficit from 20% of GDP back to 10% of GDP, and that's a borderline recession, right? So I think that COVID didn't make the Western world any any younger. I think that the forces of tech deflation remain everywhere. And whilst, and I'll get onto the climate agenda in a second, and whilst, the fact that, if you get to 30 million EVs by 2025, there ain't enough copper in the world, and copper could go to, $25,000 a ton in the next several years, perfectly conceivable. That's not an inflationary world per se. That is pockets of inflation, but in the aggregate, we've seen 40 years of continual disinflation, yet we have more money in the world than at any time in human history.
So you don't buy the argument that COVID ushered in a change in attitude about deficits, and you think that we'll return, once we get through this pandemic and once it's firmly in the rearview mirror, the kind of fascination with balancing budgets and bringing it in will return, and then we'll be back to business as usual.
So, but the problem, and again, you've got to talk about where you are, but let's be US centric here because that does drive the world, right? Yeah. That you can't, and I'll use David's words again. You can't have sea change when you have a 2-year election cycle.
Okay.
Right. You don't structurally change an economy with a 2-year election cycle, right? We were going to get inflation under Trump. Didn't happen. Barack Obama was a communist, and we were going to have UBI under Barack Obama. Structural disinflation the whole time, right? Clinton was a communist, right?
Yeah.
George Bush was going to be Mr. Infrastructure, right? Didn't happen. So it's if you are constantly on this cycle where Republicans when are now going to have their come to Jesus moment, and suddenly fiscal discipline will return after reckless spending under Trump. Why? They're in opposition, right?
Yeah.
So I think that if you don't get anything done on this front, 20% of GDP as a deficit is unsustainable. That is going to shrink, and that is going to shrink growth dramatically from the mid 2022 onwards.
Okay, so let's walk through how this plays out then. And you mentioned that you think rates go higher over the short run. And we buy that, as we're in the midst of this kind of fiscal high with all the spending. But then the midterm elections come along, the Democrats pull back on spending, and all of a sudden you were actually forecasting a recession at the end of next year.
Yeah, I could easily see that happening, right? Because again, so what have we got? So what we got at the moment is the summer of Sodom and Gomorrah, right? Because there's a bunch of 30-year-olds who have not had a boyfriend or a girlfriend in 18 months.
I saw that the vaxxed and waxed is what we're supposed to say, Paul.
Correct, and everyone is going to go nuts this summer, right? And I'm taking I'm going to take the kids, my son away. We're all going to have a great time, right? But what actually this is compressing 15 months of aggregate demand effectively into a 6 to 9 month period.
Okay,
right. So. And again, people get this wrong in this way. This is not a normal cycle, right? Because we forced shut the global economy, and now we're forcing it open, right? And you're going to have disconnects in that, right? So for example, it's really hard to get a bike in the United States right now.
It's brutal.
Brutal,
One of my
right? Can't
buddies
get a-
is
can't
trying to
get a
buy a
bike.
mountain bike. He can't buy one. There's not one in Toronto.
Right. And why is that, right? Because during the crisis, when the bike factory was shut, you can't make bikes at home.
Yeah.
Right?
That's
So you
true.
reopen the factory, and everyone in the 9 months who wanted to get a bike, who couldn't get a bike, now wants a bike, and demand for bikes go through the roof. But that's hard to produce those bikes because the bike factory is only at 50% capacity, and now it's 100%.
And it's
they're
competing on the
scrambling to get back home.
Right.
But Kevin, is there a structural demand increase for bikes?
Well, yeah. No,
Once everyone gets a bike,
yeah.
are we going to recycle our bikes every year and the like? I mean, I think so. Again, it goes back to this whole notion: 15 months of aggregate demand compressed into 6 to 9 months, right? But are we going to take more trips to Disney, or are we just going to take the trip to Disney now? Right?
Yeah.
We might eat out a little more than we did to make up for lost time, but are we going over time? Are people going to eat out? People used to eat out once a week. Are they going to eat out 3 days a week?
No.
Yeah. So I think that there's a lot of change that simply just may not occur, right? And again, the growth tends to be, we haven't seen anything that has structurally increased productive capacity in the US or global economies because of this, right? And at the end of the day, GDP is about how many workers you have, how hard they work, how many hours, and how productive they are, right? So, the size of the labor pool, could have a little bit more immigration under Biden, but frankly, that number's pretty stable, right? And if anything, with the way the demographics are going in the US, that number's always guaranteed to be a bit around the same number, right? Hours worked, well, we know from the Japan experience that the older people get, the less hours that they work, right? And frankly, if you look at a chart of hours worked, it's roughly been about between 34 and 35 for the last decade plus. It spiked to 36 or just under 36 during the pandemic because people don't commute.
Oh, yeah, they just spent that hour commuting, actually working now.
Correct,
Yeah.
right? Correct, right? So what's going to happen when they start commuting back to work? That number drops back to the 10-year average, right? And then we go to productivity. This is what they give out Nobel Prizes for, working out where productivity is heading. But you have to admit that the productive gains that we have seen, not just from the big structural things like cloud and the like, but just Zoom is a wonderful example of a incredibly productive tool that is going to be with us permanently, right? So we could see a jump in productivity that helps, but productivity is not an inflationary force; it's a deflationary force.
Okay,
right?
So now you mentioned negative yields. This is, I'm always intrigued by people that make out there calls, and that's definitely an out there call. Do you see just the long end going negative, or do you actually see the Federal Reserve, breaking the taboo and going into actual negative yields?
It's the $64,000 question, right? So big picture. If you look at the demographics of Japan and the demographics of Western Europe, the US probably gets there in 5 years' time, something like that. Again, very immigration dependent and the like. But demographics in the US is not great, right? Demographics in Canada are not great. Demographics in Australia are not great, right? And there is a long history. Oh, well, sorry. Japan and Western Europe, of countries with poor demographics eventually having negative yields. And the problem is that you can't get out of the mix. Now, I think that the one advantage that the Fed does have is that it has seen what has happened to both Japan, the banking systems in both Japan and Europe, and there is a case to be made that this is actually a terrible idea over the long haul. But look, I mean, we've seen time and time again over the last 40 years that the 2-year note determines Fed policy, right? Yeah. So if the Fed says they're not going to hike and there's 3 hikes in the 2-year, they tend to hike.
That's
right.
Although they're trying hard now.
Yeah, for sure. I mean, again, it's if is policy appropriate for what we're seeing right now? It's probably not, right? I mean, I think it's inappropriate for different reasons. I mean, the Fed doesn't need to be buying bonds of Microsoft or Apple.
For sure. Like, there's no doubt about it. It's the QE portion. It's probably rates should be left unchanged. The question is, do the QE, do they really need to be doing that?
No, Bill Gates has had a bad couple of weeks, but Bill doesn't need to have his bonds supported, right? Yeah. It's as simple as
He's
that.
had a really bad couple of weeks. Actually, the more you find out about that guy, you're just like, whoa.
Bill Gates did that.
I know. It's kind of funny. Okay, you mentioned copper. One of the things about copper that always kind of worries me is that it's very consensus trade, but there's, sometimes like you talk about the 3 to 6, it could just be we're, at the still in that midst of that move from 3 to 6, and we're a long way from being kind of everyone all in on it. What is I see from your list of positions that you're long copper. Is this something you just buy and forget about?
So Kev, it's very rare that you have an idea that again for a different thesis can work short, medium, and long term, right? And copper and particularly copper stocks, because I tend to like the underlying, even though you do take, obviously there's tracking and tracking risk with this, but correlation risk with this, but the underlying stocks tend to work a little better because you're never in a position where you've got negative carry on rolls or stuff like that. Copper works short, medium, and long term. It works short term because of the fact that it is the perfect. If you are worried about inflation, it's the perfect inflation hedge, particularly over the course of the next 6 months where we are going to have just gangbusters growth globally. It's a fantastic hedge near term about inflation, right? Over the medium term, you've got that supply dynamic in place, which is it takes north of 2+ years to put a copper mine, to get a copper mine up and running. We know that the regulatory cost of doing this is significantly higher than it was. We know that the operational cost of getting a mine up and running is significantly higher than it was. So we know the copper supply is currently tight. It's going to take I'd say at least 3 years for any truly appreciable increase in copper supply to come on board to dampen prices. So over the medium term, that's your thesis, and then the long haul is all about electric vehicles. I think that. Bill, again, going back to Bill Gates. Bill Gates once said that on a 12-month view, things rarely change. On a 2-year view, things are exponentially different.
Okay.
Right. And if I was to say if there's one thing that people are underestimating, the consensus number, if you talk to anyone in the EV space, is that there's going to be 30 million EVs by 2025.
Yeah.
If we had 50, I wouldn't be shocked.
Wow.
Wouldn't be shocked.
So you think even though everyone's bullish on the EVs and expect it to change, you think the change will occur even faster than what the market is priced in?
So again, why I asked this question: if Ford have released an electric F-150, right, and you can get an electric Hummer, right, what is the reason you would buy a combustion engine vehicle at this time?
Wow.
Right. I mean, Lamborghini announced this week that by 2030 they'll have an electric car. Congratulations, guys! You're on top of that. But I think that there is. I was going to use the word virtue signaling, and I think that's not fair. But I do think that there is going to be. There's no reason for anyone who is remotely environmentally conscious, given the growth in infrastructure that we're seeing from a charging station standpoint, particularly in China. I mean, there is zero reason in China for anyone to own a combustion engine, right? So I think that the growth of EV globally is going to be just exponential. And with that, I think the number is something like there's 20 times the amount of copper in an EV than there is in a conventional combustion engine. The implications of that are very clear.
Wow. Okay, there's so many positions here and you know what? I was kind of laughing when I saw them. I was like, geez, you've been looking at my inventory. There's so many that I agree with, even though I have trouble with the negative rates in 2022, but we'll agree to disagree there.
Well, no. We're going to be negative rates are going to be a bit. It'll probably 2020, 2025.
Okay.
I'll give myself a bit of cushion.
Okay, that's right. Far enough that everyone will have forgotten. Okay, let's just go through. If I could, I just pester you with a couple more here. One of the things I see is you're long the banks. You're long European banks, the U.S. banks. European banks are, again, one of those things that FinTwit and all the other gurus love to hate, and here you are long them. Walk me through your reasoning for, to be long the European banks.
It's a 6 month trade. It's again with commodities. It's a fantastic positive carry expression of higher yields. Look, the dirty little secret amongst the macro community is that short fixed income trades have been a killer for people this year, right? And the reality is that if the worst possible scenario for being short rates is if they grind higher, right? Because the negative carry will just kill you, right? So the way you do that is you buy banks, particularly developed market banks, with positive, obviously the dividend with significant dividend yields. Right?
Oh, okay.
So Europe makes, and let's face it, a European bank long position is no different to being short bonds. And if you're going to have a true inflation problem, right? And the reality is, Kevin, is that it's not about when you're constructing a portfolio, it's not about whether inflation returns. It's whether everyone thinks inflation is going to return, right, and it trades that way.
The old beauty contest. Your job is not to pick the most beautiful person; it's to pick what the judges will view as the most beautiful person.
Correct, right? And if you do have legitimate inflation fears and bunds go positive, right? And I think, put it this way, there's no way the market truly believes in global inflation if German 10-year paper is still negative.
Well, that was going to be my next question, because you're also short the bunds.
Yeah, well, look, it's the ultimate expression of this, right? And again, being short an asset with a negative yield, you don't pick up any carry. It's actually I'd argue it's probably slightly negative carry with the
overnights being the minus 50,
exactly,
right?
Exactly.
Yeah.
So I think that it's just, for me, it's, if you look at the portfolio, it's really a barbell approach, right? Obviously, I'm implying through everything I've said, I love growth equity long term, right? I think there's 20 companies I think are completely transformative globally, and everybody should own these companies for the next 20 years. But there will be periods where you have drawdown, and you have underperformance versus value, and that's what you have now. So, what I think the approach needs to be is, particularly for the next 6 months, is you can still own a bunch of this stuff, right? But it's got to be the quality. It's got to be, it's Amazon, it's Microsoft, it's Google, etc.
Well, I was going to ask you. It was going to be my next question. You mentioned there's 20 companies that you should own for the next couple of decades. Are those your top three? Are those your favorites?
So what are my top three? All of them have this in common, that the 8 mega themes that I spoke about, they will all participate in those in some way, shape, or form, right? So for the last 50 years, every decade, the top 10 market cap companies recycled, right? It was always different, right? And my base case is that era is now over. So the top 10 market cap companies in the world, excluding Saudi Aramco, right, are all technology companies, right? And the reality is that the addressable market for Alibaba, for Amazon, for even Tesla, certainly Tesla, and the like, has never been greater. So ExxonMobil was once the world's biggest company, right? Tesla can be the world's biggest energy company, but ExxonMobil can't make cars, right? JP Morgan, right? JP Morgan won't be able to do e-commerce, but there's a chance that Amazon eventually is its biggest rival in financial services, right? Google, Pfizer can't do search, but Google, damn right, it's about to do healthcare. Right, so I think you've got to own a lot of these stuff, and I think the big observation in all this, Kevin, is that you can argue, that there's 15 that pick themselves, there's 5 that are sort of on the fence, and you can go back and forth on those. But what is clear, that anywhere between 14 and 16 of those companies are all domiciled in the US, and that's one of my primary reasons why I'm not overly bearish on the US dollar. Because if 15 of the 20 greatest companies in the world are domiciled in the US, to sell those companies to buy a cheaper Japan or a cheaper Europe or a cheaper EM is a trade and nothing more, right? So, actually, do you want the list of the 20?
Sure, go for sure. Everyone would love to hear it.
All right. So the list are Amazon, Alphabet. I do Alphabet and Google in the same list because I think you should be doing that. ASML, Apple, Netflix, Tencent, Alibaba, ByteDance, Shopify, Uber, Tesla, Reliance, which is probably my favorite, PayPal, Ping An, TSMC, Microsoft, Walmart, Facebook, and BlackRock.
Okay, tell us why Reliance is your favorite.
Because
and what's the symbol? Where do I?
So it's a GDR. It's REL, I think it is.
Yeah, in London. Okay.
Yep. So it's a GDR, and it's traded in India as well. So Reliance. So India is. Okay, let me put it this way. So we're entering an era of tech, what I call tech nationalism, right? So France is a good example. France would never operate in a world where it didn't have its own trains and it didn't have its own banks. Yet France is very comfortable with its growth industries of search and e-commerce dominated by American companies, right? So, 18 months ago, or 16 months ago, India kicks out a bunch of bans a bunch of Chinese apps after the border skirmish, right? And India has a diaspora of infinite intelligence and capability, has infinite access to capital, and what you'll see in India over the course of the next decade is building out its own Alibaba, its own Facebook, its own Instagram, its own TikTok, its own ByteDance, etc. Right? And Reliance Industries with Jio it's front and center of all that. Now, last year they raised $24 billion through strategic stakes with Amazon, Facebook, Silver Lake, Apollo, a bunch of firms, all investing in their mobile business, their search business. I mean, they have so many patents on healthcare and the like, and it trades at 1/10 the valuation of Amazon. Oh, sorry, 1/10 the market cap of Amazon.
Right, with a monster market in front of them.
1.3 billion people.
Right. Okay, listen, so much to to think about there, and there's some great stuff in terms of out of the box, completely different thinking, stuff that I haven't heard in a long time. Negative rates, you're still blowing my mind about that. I'm not going to let you off the hook though without some questions. I didn't warn you, so I hope it's okay.
No problem.
Okay, we're going to go with your favorite investment book.
Favorite investment book? No, I've got it. Yep, got it right. Got here. The Rise and Fall of American Growth by Robert Gordon.
Oh, there we go. And out of the
so it's a book basically. It's basically a book on productivity, and it's basically showing how the American economy evolved over that time. Market Wizards obviously a big favorite as well, just being old school.
Yeah. Well, it's not many of us that can say they know a bunch of people in there like you.
No, it's good. No, I've been very lucky in that regard. Very, very lucky in that regard.
Okay, speaking of Market Wizards, my next question is, are great traders or investors, you pick, are they born or can they be made?
They're born.
Oh, really?
They're born. I think it's incredibly instinctual. I was lucky enough to work with Mike Novogratz.
Yeah.
And Mike has had an absolutely extraordinary career, and Mike is Mike's one of those guys who just, I think you are very instinctual in what you do. I use Mike as an example of that. I think he's an incredibly instinctual guy. I think you were born that way.
Okay, and the last question, if you could meet the Paul of just graduating from university or college and was headed off to Asia to start his job, what advice would you give him?
don't get married till you're 40. No, and I mean that in all seriousness, mate, because you don't know who you don't know who you are until you get older. I've been very lucky that I my now better half is in London, and we met when we were in our I was my mid 40s, and it's just you don't know how this works, and divorce is one of those things which is just so scarring for people, and I think that's in terms of your own wealth, ability to create wealth, it's who your life partner is so vitally important. It's so vitally important for your emotional well-being. And at the end of the day, unless your family life is stable and happy, and whether it's with family or friends or whatever, all the other stuff just is just you can never get the other stuff right unless you are personally happy.
Well, that's some good advice. Okay, so Paul, why don't you tell people where they can find more about you and your great product?
Guys, you can get me at uschinaseries.com. You don't get me on Twitter because I'm not a Twitter guy. But uschinaseries.com, you can get me there, or hit me up on LinkedIn.
That sounds great. Well, thank you very much for being with us. It was a real pleasure getting to know you, Paul.
It was great, Kevin. Thank you so much.
Okay, Patrick, it's time for Talking Charts. What do you have for us this week?
Okay, let's get through the top three things from last week, talk about the top three things this week, and then go a little random on the charts. So last week we were talking about inflation and how the numbers would come in the developed markets.
And it didn't really shock anything. There was nothing really to report.
No. I mean, everything was... Yeah, it was. Everything was baked into the cake. We also were asking whether we would see that 175 on the 10-year yield broken, and that 10-year yield just is not budging. And, it makes me ask the question, Kev, how much of this has now been baked into the cake? I know that the inflation call and you inflationistas doing all that stuff, but there's a point where if the yield isn't moving on this kind of news anymore, then how much, I ask the question, how much is baked into the cake? I mean,
I don't know. It is kind of disconcerting because people actually agree with me that rates are going higher. Not Paul, obviously, but everyone else seems to. And whenever everyone agrees, it's often the surprises end up the other way. So I'm a little worried, Patrick, that you might be right.
Volatility is narrowing, and so it's not that hard to put on some interesting trades, betting that this might go the other way. But the one thing I was giving the bulls the benefit of the doubt, because that pullback that we saw right after the
bulls and rates, or the bulls and bonds.
The bulls in for rates higher. Yeah. Your little crew. And I was like, it came off for a couple of days off the inflation number, which is sometimes when something overshoots a little bit, it kind of mean reverts. But really, there was a chance for them to break it out in the middle of this week, and they gave it all back. And there's just no momentum here. They simply can't seem to take the rates higher. I think,
you sound like you're bullish bonds. Just say it.
No, I'm more neutral. I'm more skeptical that they're going higher. I don't know how bullish I want to be bonds.
You know what? The world is returned. Nature is healing. You're back to being. You're almost there. You're almost bullish bonds.
Almost bullish bonds.
And I'm bearish. And the world's almost back where it should
And then
be.
the huddle is back to being normal. Yeah. It's and the last thing we were talking about is whether those were the highs in commodities. And what is interesting is oil did take quite a bit of a reversal in the middle of the week, obviously on headline, but copper has not been able to really to turn back. I mean, overall, oil hasn't really done anything bearish. Like, okay, it did have a pretty big drop on the downside for a couple of days, but rebounded a chunk of it. I mean, a lot of people want to already call that a double top and some big topping formation, but if the bulls get oil back to 66, there's nothing really bearish about this price action yet.
One of the things, though, Patrick, you did ask, was that a short-term high in commodities? And I have to say that it looks like it was. The whole week was distributive, like when you look at the actual index, right? Like, do you get the Bloomberg Commodity Index or no?
Yeah, right here.
You didn't have that.
That's definitely. It's been
the whole week
selling
was
for
like,
the whole week. Yeah.
It was for sale.
And I mean, lumber
lows.
bounced, but let's talk about, for instance, copper, right? Like copper where do I have the chart here? Copper basically has just been slowly, I mean, it hasn't been a bloodbath or anything, but the highs are in, and it's been giving back much of that April rally. Not much of it, but it's giving back, and so some sort of short-term high is in. And maybe that's what's allowing the yields to kind of just be stable here. And that nervousness about the big push in commodities isn't really there now. I don't know. One way or another, short-term high does seem to be in.
So what are we watching for next week?
Well, let's talk about the fact that usually in the week following a monthly OPEX roll-off, like as option expiration approaches, volatility tends to return. And that's not necessarily directionally biased, but rather simply we have a contracted volatility range, and then the market starts to actually be unpinned, and there's more room for it to make a bigger trend move. And I think the big question here is, are we about to get next week a proper trend move in the market, either higher or lower? I have a bias, but we'll be watching whether or not that volatility returns.
Let me guess, your bias is that we're going to have more volatility than it's going to be to the downside.
Actually, well, let's talk about the charts here in just a moment. You know what? Number two. Number two was whether or not the FANG stocks can turn up. Actually, you know what? Number two fits into the narrative. Let's actually talk about this then. And so the FANG stocks have been the dogs. So I'm going to just use this FANG index futures just to kind of get an idea of just how weak and how there was a complete lack of participation in this space. The NASDAQ has at least rebounded 50% of that of its drop, and S&P's within a stone's throw of the high, right? And the FANG stocks can't even get off the mat. And I think that this is one of the most important things to watch next week, because in my mind, that bullish breakout on the upside in the market needs the FANG stocks participating. Like with the cyclicals already having exhausted themselves and the financial sector having already done so much of the work on the upside, there needs to be a broader rally. And these mega cap stocks, in my mind, have to join the party if the S&P is going to break out towards 4,400 or 4,500 on the upside. I'm not ruling it out, but I definitely think the FANGs are the place to watch, because I can't imagine S&P punching new highs without the FANGs giving some sort of tailwind. Any opinion on that?
I don't know. I was going to say that this post-OPEX idea that volatility was going to increase, although I am sympathetic to that, I question whether on a regular OPEX, meaning a non-quarterly, whether it really matters as much as you're making it sound.
Well, no. Look, all we're just talking about is the fact that there's a potential for a trend move. All right, so let's not make a big deal of that. But the bottom line is that with the question of whether the S&P here, let me put up that chart on the S&P, is capable of punching to a fresh high. And my argument here is that in order, so far, let's just put a 50-day moving average on here, and so far, it's held its moving averages. It's rolling up. In order for the S&P 500 to go and punch to 4,500 on the upside, which I think is capable of doing so long as it can break out, I don't think this breakout happens without the FANGs participating, is the point I'm making.
Okay, I'm not going to disagree with that.
Right?
I just think, though, that there's a good chance that we grind more so than you think next week.
You just think it's going to be flat, like that we're going to stay in a 100-point range? Because I think that this is a bet.
Well, anyways, you want. Well, we'll talk about that later. Number one, what do we watch?
Number one, I wanted to just mention lumber. If we ever wanted one commodity that is on steroids in terms of volatility, it's got to be the lumber chart, right?
It's got a lot of zip.
Is there any other commodity that goes limit up, limit down this often?
Well, if there was limits on the asset that shall not be named, it would be in that kind of league. But that is the only asset that you could really compare to lumber.
Yeah. This is extraordinary. Literally, it doesn't trade because it just goes limit up or limit down. And almost every day. Anyway, this we clearly had a short-term high, and it interestingly happened about that at the same time as that CPI, the hot CPI print came in. lumber was giving it back, but it did a 50% retracement down to its moving averages, and we're bouncing. And I think one of the interesting things, like we had a number of guests that talked about things like the lumber gold ratio and all sorts of other things they're watching. And it was really interesting to see whether lumber is done or not. And in my mind, the bulls still have a chance to save this. The bulls can get this thing north of 1,500 and show some constructive bullish price action. And maybe lumber may still have another move to 1,900, maybe even 2,000 on the upside. But if lumber can't make and clear 1,500 next week and starts to just lose momentum and just start chopping around for a week, then it increases the likelihood that the major high is in. And I think that there's a lot of macro implications if we see it. I'm watching lumber.
Okay.
No opinion?
No opinion. Okay, what are we going to talk? What do you got for your
no opinion, which means I just said something stupid. All right.
No, it's not that. Okay, what do we got? What do we watch?
Let's talk. I mean, all right. Let's look at this chart on gold, right? And what I've wanted to just start off here, just talking about the fact that the bulls are there's some good flow here. I mean, every day it seems every time they try to reverse it, and it's down a little bit on the day, the bulls come in, buy it, and take it right back toward its multi-week highs. There is good, healthy accumulation happening here, and it's in good bull trend. We've cleared 1850, which is a fib retracement zone. This is a positive price action in bullion, and it'll be really interesting to see whether this gets north of 1900 next week. I think it really can.
Oh God, I hope you have a good read my trade, buddy.
All right. Well, okay. Shh. Don't tell anyone.
Okay,
all right. So the dollar index at major support, and now there's zero bullish price action yet. So nothing to lean on other than that this has been the 2021 lows. And each time we've tested this zone, it's acted like support. And watching whether the dollar actually finds support there, I think is really important. And that's same with overhead resistance on the euro as we approach this kind of 122 to 123 zone where all these previous highs have occurred. It's going to be really interesting to see whether this is going to be a resistance points for these. Without making a big picture call on the currency, this is a kind of key technical level, and it'll be really interesting to see if it turns here.
So here's an idea for you on the dollar. I think we're going to get a reverse prairie dog. We still haven't figured out a name for that. We're going to get a surprise move. All the technicians are going to get all bared up and talk about it, how it's going to go down, and then that's going to be when the rally comes.
I could see that, but now that could happen on the Dixie,
that's
because the Dixie's right along the low, but maybe the euro doesn't. I think you would almost need a double confirmation where you would need the euro clearing this 123.5 on the upside in order to really solidify a Dixie breakdown. I mean, it is 57% of the weighting in the index. And
I just think that when something's that obvious, it's not going to bounce on there. It's going to mess everybody up.
Well, wash out all the people reacting.
That's my 2 cents.
No, you know what? It makes sense. And then, so let's talk about the asset that shall not be named for a moment.
Oh God, really?
Yeah. And so we're not going to say what it is because our listeners might know.
Let's look at in case somebody's tuning in for the first time. Although they probably haven't lasted this long if they're tuning in for the first time.
But this is the chart on Bitcoin. But you know what? This has been very distributive. Like even the bounce that happened in the middle of the week off of that devastating blow. I was expecting that if the bulls really had it together, they could have cleared 45,000 on at least a reactionary bounce. And again, the same China headline news coming out again today. Just it's so distributive. It's just negative price action that is not a good sign for the bulls. The last time we've seen these types of turns, they lasted half a year to a year in terms of Bitcoin consolidation. Now, each time, note that the bulls were able to buy the dip, 6 months later or a year later, and in fact go and even punch Bitcoin to higher highs. So I don't want to say anything overtly super bearish or anything, but definitely there was a very strong bull run throughout the first part of 2021, and that bull run is definitively over. And so the question now is how long and how deep does this consolidation go? Is one of the interesting things to watch. I mean, at this stage, it doesn't look good.
Thank you for that analysis, Patrick. Next topic.
Thank you for that analysis. Let's just touch on junk bonds.
Oh,
we haven't talked. No, but like, you know what? They just have been dead.
Because they've got a short duration and there's no credit problems so far. So they're going to be boring. They're just like, it's like watching
well, I mean, I just wanted to mention that they were boring. So that you're confirming that they were boring. So hey, there we go. Let's talk steepeners. Let's touch on this. So the 2s, 10s. Now, obviously, because the front of the curve is pinned, this is really a call on where yields are going next, right?
Yeah, and also listen. There's no doubt that some Fed members seem to be floating talk of taper. And ultimately, anything that advances the eventual hiking of rates will affect the front end or the belly of the curve more. So it's not surprising that this is paused for a little while.
Yeah.
Really, what you should see is in terms of everyone thinks that a loose Fed is so good for bonds, and I've always argued no. Like the worst thing you want as a long-term investor in fixed income, is a Fed that's willing to let inflation run hot. So as the Fed, walks that back, there's a good chance that I hate to say it, but Patrick might be right and bonds rally. Listen, I'm not putting that on because that's the kind of the dynamic that people don't understand is that, or not that they don't understand. Some people confuse is that unfortunately a Fed that shows more willingness to clamp down on inflation will actually cause bonds to rally and cause the curve to flatten. So, and given that everyone's got this trade on, maybe we are due for that, Patrick. I don't know.
Well, just a little bit of a mean reversion. I don't think that in the bigger picture, like there are secular trends that, and this is the big thing: is it transitory or is it secular? I mean, this is one of the big debates. That's why we have all our guests come on and we talk about this because it's such an important thing to answer. But one way or another, there are cycles within this, and even if you are proven right in the bigger picture, doesn't mean that this thing can't mean revert down to 1% in over a couple of months, right?
Yeah. You're absolutely right. Like in the long-term point of view, like if you think about it, it could still be a bear market in bonds even with a move back to down to 1% or 110 or whatever.
Absolutely. And so this is where time frames become such an important element in this. It's there isn't much asymmetry in pressing the yields higher trade today. And that's I think that it's a crowded trade, and at some point it can be washed out a little bit.
So
sure.
I'm not sure I agree, but anyways, go on. Let's go on. That's what makes the market.
I just wanted to do a couple individual stocks. AT&T, obviously, there was that big news. There's speculation that they're cutting dividends, that they're going to obviously do this. Their like Warner division, merge it with Discovery and spin it off and do all sorts of stuff. At first, the news was interpreted incredibly bullishly, and then the stock just got completely hammered to the downside. It'd be really interesting because this is one of those stocks that was a core holding in people's dividend portfolios. And the question here is that if they kibosh their dividend, are we due for this thing to really get into some further pain?
I'm not up on the story. I didn't realize that it actually had received it so poorly.
Yeah,
so you tell me that big red candle was when they announced Discovery?
Well, they announced it at it jumped higher. It was almost at $34.
Oh, and then they said and
then when they were doing all the dividend stuff and all these other things, speculation came in, and then they just murdered it. on the downside. But it's going to be really interesting to see. Like, I think it's huge because once a stock gets labeled like a big, I guess the term is it like aristocratic dividend pay or whatever they call it. I don't know. I'm making shit up now. But basically it's like when you're a big dividend payer, then it belongs in a certain style of investors' portfolios. And if AT&T is changing its stripes, what does it mean for the stock?
Well, and no doubt, Patrick, when a company changes its its underlying holders, meaning that if it changes the tone or the characteristics of it, and it does have to go from one hands to the other, often you're right that it will mean short-term kind of pain as that transition occurs. But it doesn't necessarily mean the end of the world.
No, it's not an end of the world. What's interesting, actually, is that the implied volatilities are not crazy. And even like you go to strikes down at 28 and 27 on the options, they're not exactly pricing in big tail risk. So I think the question is, has maybe all this now been repriced in? It doesn't seem that market participants are overly worried about a big move. But you know what? Can AT&T make it back down to 10% lower, down to $27 and retest those lows from 2020? Maybe. But
I guess when you're paying 20 vol, it's a good little punt, is what you're saying.
Yeah, I mean, it'll be interesting to see what happens there. The other thing is, let's go back to those FANGs, and let's look at those Amazons for a moment. And what's interesting to me is that Amazon has been, it went from being the darling during the first part of 2020 off of the COVID lows. I mean, this thing went ripping from 1,700 to 3,500 to being dead for the last year. Like, we are going almost on a year of complete and total sideways price action on Amazon. And obviously, it's one of the core FANG stocks that has been pulling back recently. And I think that the major next trend of Amazon, when it breaks out of this trade range, is going to be critical to this, because these stocks are the behemoths, and right now, like if you take the high and the low range of this trade range, we are in the dead center of that trade range. Like there is zero imminent breakout of the trade range on the stock, but I think this is one of those stocks that to watch as to which way the prevailing trend really starts to establish itself.
So I got two words for you.
Uh-oh.
Jeff and Mackenzie. They're both selling tons.
Yeah.
Like, meaning Jeff Bezos and Mackenzie. Is she still Bezos, or is she something else? I think she's something else. Anyways, I think that there's a lot of selling, and it seems to be chewing through it. And I think it's just one of those things. It's probably more boring. Like, the reality is we're all staring at this expecting some excitement, and maybe there's no excitement. Maybe we have another.
But this is the whole point, right? Like, these behemoth stocks are such huge market cap factors into these indices that, like, how can you yes, can the S&P go higher? Can you be positive on your returns when owning something that's benchmarked on that index? Yes, but in order for us to have the S&P 500 make a solid 10 or 20% advance, which is the type of returns that a lot of people want.
Okay, but Patrick, I want to stop you there, because we've begun so used to these 10 and 20%, and in fact, it's 10 and 20% per month these days. The reality is, when you go look at stocks over the long run, it's like, what, 8, 10? Well, I don't know what the number is, but it's nowhere near.
Yeah, but the thing is that but we're talking about the fact that generally the market, we're talking right now. So now,
but Patrick, think about it. Think if you were going to do 25%, it's 2% a month. Like, or it's a little less than 2% because it's annualized, but compounded. But
okay,
the reality is that 2%.
Okay, so let's just say include 2022. Let's talk about the idea that the S&P is heading to 5,000. All right, like that over, and whether you're not in this year, not in this calendar year, but the general path over the next 2 years is that the S&P is going to head up to 5,000, which is a very realistic expectation. We're at 4,100, right? I mean, that's 20% higher in a couple of years. That's not out of the realm of unrealistic from what we've seen in the past. In my mind, I can't imagine that kind of return without Amazon, Apple, and the others all going up. And
I think you could. I think you could see the rest of the banks go. You could
the banks
see
have already had their run.
No, but they could really go.
and
They haven't gone anywhere for years. You could get you could get energy
But they're
doubling
not-
without even blinking. There's
Yeah,
lots of
but the-
ways for it to happen. Lots of ways for it to happen with these tech stocks still going sideways.
Well, okay, but sideways. But what if there's general rotation then, and these fangs are going down
Okay,
while
so
the
that
money's
ends
going-
up being more difficult.
All right. Okay,
I'll give
we
you
agree.
that one.
All right. That's that. Anyway, I think that's enough for today.
Okay.
But that's the kind of stuff that I wanted to talk about. All right, let's move
Okay,
on.
time for this week in trading history. What do you have planned for us, Patrick?
Well, we're going to go back to May 17th of 1792, and it was the signing of the Buttonwood Agreement and the creation of the New York Stock Exchange.
Hey, I sent you this one.
Yes, you did.
All right.
You did. Where did you? Was it one of our listeners that sent it to you or something?
I can't remember, but I remember sending it to you going, oh, this is a good one.
Yeah,
We
no,
should
and
do this.
I was like, I gave it to Mass, and I said, hey, bud, find a date on here so we can include this in history. He goes, it's this week. I'm like, okay.
That's why I sent it to you.
Oh, there you
I'm
go.
not a
All right.
complete idiot.
Well, okay, there you
Okay,
go.
so tell us the story.
So anyway, under one of these sycamore trees, which was called a buttonwood back then, this tree was located on at 68 Wall Street, Manhattan.
Really?
And the New York Stock Exchange started as an agreement amongst 24 brokers, and this agreement was signed under this tree. And these 24 brokers made a deal that they can only deal with each other. Hence the when you need a seat at the exchange thing originated, and that was an agreement to do it at a set commission rate. At first, they only traded 5 securities, mostly government bonds. And so brokers traded using the Spanish milled dollar, which could be cut into pieces of 8. Hence, the long-standing practice of quoting stocks in 1/8 of a dollar, which finally ended, obviously, in January 2001 when we switched to decimals, right?
So I remember that.
Yeah,
I
do
like
too.
most a lot
And
of
we're
traders
dinosaurs.
these days
Like,
won't, but I remember trading in 8s. And then
Yeah.
it was really terrible when you traded little stuff and they went to 16ths and then they went to 32nds and the really shit stuff traded in 64ths or 128ths. Like, it was just awful.
Well, you can thank the Spanish for this.
I don't know if I should be thanking them.
And so 1 year later, they built a coffee house at the corner of Wall Street and Water Street.
Was
where
it
they
a Starbucks?
No,
okay.
it wasn't. Where they would meet and trade. It was actually the first stock exchange building then, and Tantine Coffee House it was called. The initial securities traded surrounded war bonds to fund the revolution. The first Bank of the United States stock, which was obviously the first central bank when we talked about the first, the second, and then inevitably the Federal Reserve that came afterwards. But the first Bank of the United States was traded on there, and the Bank of New York. And so it was some of the early securities that were traded there. Trading continued there at that coffee shop till 1817 when the stock exchange constitution was drafted and the trading was moved. But what's interesting, another little interesting tidbit, it was on January 4th in 1804, right about 15 years later or so, something like that. In that Tantine Coffee House is where Alexander Hamilton met his friends to talk about dueling Aaron Burr.
Really?
Yeah, and so obviously Burr bested Hamilton's hatched plan, but it actually happened in that same coffee shop of the exchange.
That's awesome.
And so after the stock exchange moved, the coffee shop was turned into a hotel and tavern. By 1830, obviously the exchange, the railroad and bank shares dominated the exchange, and the panic of 1837 sent the daily volume. Get this. The panic of 1837 sent the daily volume to 1,534 shares. in June of that year, an entire 1,534 shares traded in the panic.
In the year?
No, on that day.
On the day. Okay, good. Yeah. That's still
And
not,
so-
yeah.
Yeah, but nonetheless, it was all that coffee house was demolished in 1855, and then obviously at the start of the Gilded Age in 1865, the New York Stock Exchange moved to a grander headquarters on Wall Street, and stock trading became commonplace, and ultimately it ended where it's currently at in 1903.
That's a great story. You know, I was curious, so I put in 68 Wall Street into Google. And I went to the little, the guy where you can take them onto the street and get a street view. And if there's
a coffee shop there.
No. So this is so New York. I'm looking at it, and there's some guy, and as the Google car goes by, he's giving him the finger. It's like that's awesome. That just sums that up perfectly.
You're downtown.
Anyways,
and when you look, there's not a tree on the street.
No, that's why I was trying to see if the tree was there. There's definitely not a tree on the street. Thanks for that story,
Anyway, that's
Patrick.
all I got. All right.
Okay, time for skin in the game. And you got one, eh, Patrick?
I got lucky,
close.
buddy.
It was close.
It was close.
So why don't you tell us what it was?
But you know what? I just did a Costanza, right? I basically
you
said
did.
the easy
I forgot
choice.
I forgot you Costanza this.
Right, like I was like, it was so easy to pick the S&P, and the Euro stock had a pretty hard close at the end. I thought it was going to rebound with the strong S&P finish, and guess what? It was the difference maker.
Yeah, so you won. So the bet was whether the Euro Stoxx 50 outperforms the S&P 500. And Patrick says the Euro Stoxx 50, which is very unusual because usually he's negative everything Europe. And yet he won. So it's unfortunate he won one. So let me tell you about this game. This game is Skin in the Game is a weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, and the other guy chooses which side of the bet he wants. Every wager needs to settle by next episode, and the currency for the wagers is as follows. Duke and Duke, which is a crisp $1 American bill, which these days is worth a lot less with the Canadian dollar up here. A pint of beer, then a burger bet, a pitcher, a case of beer, 2-4, which Patrick just won. We're going to have to stick a new one in here. We're going to have to stick in the Pabst Blue Ribbon 100-pack, 99-pack.
It's got to get squeezed
and then the
in there.
bottle of wine with a $100 limit. So it's basically, you know what? Maybe we could just, instead of the bottle of wine, you could just put in a Pabst Blue family pack, as it's called. Yeah. And then finally the steak dinner, and the ultimate one, which no one's ever going to do, which is the men's Market Huddle menswear mink jock strap wear.
I'm doing chinchilla on that mink, remember?
Oh yeah, that's right. So I'm mink, Patrick's chinchilla. Neither one of us are ever doing it. Anyways, listen, the winner of the bet is obligated to create a new bet for the following week. So Patrick is going to have that honor. All wagers settle in full, and there will be no netting of the positions.
No netting.
No netting.
You owe me so many cases of beer. I owe you so many burgers. And a few steak dinners that have still yet to be settled.
Yes, as soon as the government allows us, which we're getting closer and closer, we are going to wagyu it or whatever it is.
Yeah.
Is that how I say it?
Absolutely. I'm going to wagyu your candy ass.
Wait, okay.
I don't even know how to pronounce it. Whatever. And it's going to be delicious.
Okay,
anyway.
so what do you got for me? What are you betting?
All right. The moment I said it during the talking charts and you jumped on, I'm like, we're doing it. Let's go S&P 500. Okay, so this week the high-low range was about 130 points. Let's just say about 130 points, about 3%. And I believe next week will be more volatile from a high-low range than this past week. Take your side. More volatile or less volatile?
I gotta take less. I was just trying to figure out if I could get you up, but I figured that wasn't very sporting.
So you think that a 3% range, you're taking it'll be within a 3% range from the high low?
Yeah.
Okay, I'm in. Let's
By
do
the
this.
way,
I want to roll.
You realize isn't next week? Is it? Oh
Is
no,
that shortened? No,
it's not
because the Memorial Day is the following Monday.
Yeah. So you got a full one. It's only shortened for us Canadians.
Yeah.
Because we're not working.
I still like it. So, and I'm willing to play this game with some proper betting. Here,
Yeah,
buddy.
I'm not. It's not something I feel good about. Like
burger bet. Or
okay, burger bet. I love the burgers. Yeah. Burger bet it is.
All right. I'm good for a burger.
Okay. Time for no stupid questions, only stupid answers. Lena, hop on.
Hello.
Hello.
All right.
I was just thinking about the 99 beer case.
It's awesome that you figured that out. And what's the funniest part about that is that it's in Quebec. Do they like Pabst Blue Ribbon?
I guess so.
Clearly.
Well, that was the first time I think it was available in Canada. It was only available in Quebec, which was, yeah.
They have strange things they like.
Yeah.
Like they love Pepsi. Like we don't like that as much. They like Mae West, and there's a million things like that they love. And so Pabst Blue Ribbon. Who would have thunk it?
Yep.
Yeah.
Okay, let's go with this. What do we got?
Okay, so the first question here. I enjoyed listening to number 127, Good Process, Bad Outcome. A lot of what he says makes good sense and helps to get an adult on the show. That was Ted Seides.
One second. Are the rest of our guests not adults? Oh, no, or he's just saying in terms of compared to us.
Probably.
And which is a very true point. That is good to have an adult on the show.
But it makes some concerns. Shorting doesn't work. Macro doesn't work. Nothing works. Only 50 people in the world are any good. Doesn't leave much hope for mere mortals like us. What do you take from that?
Yeah. So this was Will Thompson, right, from Massive Capital, I believe,
I
that
think
said
so.
this.
No, it was Ted Seides.
Oh, this was Ted.
Yes.
Oh, I got it wrong. Okay, Ted. Yeah, I'm going to fade Ted on this one. I'm not afraid to fade Ted. I think that there's lots of people can make money. I don't think that you necessarily need to be one of those 50 to do well. In fact, I think that retail has a huge advantage over institutional that people don't realize enough, which is that they don't have the pressures of making money on a regular basis like the institutional accounts do.
You know what? I have to completely agree with you, and I feel that what he was referencing was big money traders, which is those people that are capable of taking a $10 billion or more account or fund,
or doing it. Like so, you're saying doing it instead of doing it with $100,000, doing it with $100 million.
Yes.
And
Like there's only a few people out there, like a small handful of people that can do this in huge size, because when you become huge, you become the market. And so you're playing in a completely different arena. Retail investors, nobody knows when they're buying and selling. You just blend in. If you're flipping around $100,000 or even 10 million, most of the time no one even knows you're there. And it's completely different. I'm positive he was talking about the big money traders that there's,
Okay, well, I buy that. But I do believe that for most people, above average and even exceptional returns are more than doable with the right, just discipline and work ethic, and it can definitely be done. And I think you're at a way bigger advantage than most people realize. Because of that thing that I told you, they don't have the pressure of having money yanked from them at the worst inopportune time.
Right. All right, let's go to the next one.
So second question. Hi, Market Huddle team. Recently, growth stocks have come under pressure because the discounted cash flow, DCF, has been decreasing due to increasing nominal bond yields. However, rather than nominal yields, shouldn't we be using real yields to discount future cash flows because those envisioned future cash flows haven't been adjusted for inflation yet? Following such thesis, as real yields decreased in recent months, one could argue that growth stocks actually have become a more compelling buy versus the market selling them off. Am I a future Nobel laureate, or more likely just completely wrong? It would be great to get your perspective on this. Thank you for a wonderful show every week.
What a great question.
So listen, it was Patrick and I saw this question, and we were like, geez, I don't know the answer. And so we're going to, we don't have it. And we're going to throw this out there for other people to weigh in on. But when I first heard it, I was trying to figure out how this was the case, and I couldn't figure it out. And I was like,
but the majority of people do simply use nominal.
For sure.
But it does. I do understand the principle behind the idea of using real yield, because that's actually that's what you should be discounting it on. And I guess one of the assumptions is that if you're using that, then you have to assume that the growth stocks will be able to raise their rates at the same level that is priced in on them as by the market. And I'm sure I'm missing something. Anyways, let's just let everyone else wander in and tell us why they think that this is wrong or right. I thought it was a very interesting thing that I had never thought about, and I haven't thought about it through enough yet to get a real answer. So we're going to throw it back out there to everyone else that's smarter than us. All right, let's go next.
All right, next question. Hi, guys. Thanks for answering my questions. Greatly appreciated. So this was a listener that had submitted a couple of questions in the past. Theoretically, if everyone printed money equally as vigorously, is any wealth actually destroyed? Is hyperinflation destructive if there is no flight to safety in other developed economies? Thanks again, all.
Well, first of all, by printing money, like, wealth isn't actually destroyed; it's diluted, and there's winners and losers. But if you think about it, if all of a sudden tomorrow everyone just, like, let's just take one country, let's just take Canada. So our central banker goes crazy. All of a sudden, every dollar in your pocket is worth $2, and everything would go up by twice as much. And the amount of real wealth in the economy wouldn't change overnight. What would change is the certain people that owned it, in terms of those who had debts would find them easier to pay off, and those who had assets in terms of fixed income
or savings, more importantly,
savings would have them diluted. But the actual total amount of wealth wouldn't change. Now, ultimately, you could argue, and this is
a transfer of wealth.
There's a transfer of wealth within it, but as a whole, there's no actual destruction of wealth, except that then the hard money guys will tell you that people will leave Canada and then it'll be less well off. But
hence the point, which is that with one country, like let's say when Venezuela went through their little hyperinflation phase, it was a country in isolation, and so everyone was abandoning that and wouldn't trust Venezuela or its currency or anything like that, because everything else around it was stable. But when everybody is arguably printing money at the same pace everywhere, there's no safe haven, right?
Right. So if every country in the world decided to double in whatever form they could, then everything would go up by 100%, just like in our example, and there would be transfers within the country in terms of who won and lost, but there would be no country that would benefit from this. And what you could argue is that really what they would have, in essence, done is devalued against real assets, because things like gold and real estate and all those things would have obviously gone up because they haven't changed. They're still the same amount, but now there's twice as much currency out there. So that's the one thing to think about, is that, there's winners and losers within the kind of the dynamic. And then the other thing is, there's no doubt that when one country devalues on its own, it doesn't accomplish much because they get inflation and it gets a little complicated. One of the ideas is often that all countries need to do, inflationary, when we hit an actual kind of point where the world's economy needs stimulus, it's often important that everyone does it together, because otherwise what happens is that certain countries steal more growth by,
capital flows shift.
Yeah, and so there are weird things that way, but I hope that answered your question. Probably didn't. It's probably a stupid answer.
All right.
Lena, what's our next one?
Our next question. Hi, Lena. Hello. This listener.
This one's
was
for
trying to
you,
ask
Lena.
me a question, but it's not a question for me.
Okay.
I've been working on Wall Street for 20 years and feel dumb as a box of rocks asking this, but how do prop trading firms fund themselves? What is the difference between a prop trading firm and a hedge fund? Why would someone start a prop firm instead of a hedge fund? I assume prop firms are levered at crazy high levels. How come we never hear about prop firm blowups? Thanks.
Okay, this is a great question. I'm going to take this one. It's Kev. So yes, prop firms are levered at crazy high levels, and there are blowups. There's no doubt about it. So it's just that they, in essence, don't end up being that big because a prop firm isn't running, billions of dollars like a hedge fund. So let's just talk about what's the difference between a hedge fund and a prop firm. A hedge fund is a firm that takes in money from clients and invests them in a variety of different strategies, whatever the hedge fund, advertises and is allowed to do, and earns a fee. And it's much like a mutual fund, except that the fees, the charges are much higher, and they're generally a percentage of profits. So, in the old days, the hedge funds were 2 and 20, meaning that they got 2% management fee and then 20% of the profits. And what you would find is that, when they first started, they were the smartest managers would gravitate towards hedge funds because the fees were highest, and you would end up getting these managers with all sorts of volatility, and they make themselves fortunes. But since then, hedge funds have actually changed their nature, and they're much more, let's just say, less volatile, and they're trying to earn a steady returns for people. Now, let's contrast that to a prop firm. A prop firm is a fund, or not a fund, it's a firm that is trading on a prop, meaning a proprietary level, meaning trading for their own book. Now, generally, prop funds are kind of funded by the principals or the owners. So what you'll often find is there'll be somebody that's made, a trader that's made himself some money, him or herself some money. They start a prop fund, and so let's say they start with $10 million. They have this $10 million, and they're trading it around aggressively. And what they'll do is they'll hire, a trader to come and trade portion of it. And one of the things is that intraday, these funds are allowed to take extreme leverage. I don't know the exact level, but it wouldn't surprise me if they're 10-1 in terms of their size, that their broker allows them to hold intraday. But the important thing to realize is that they're not managing anyone else's money. The prop fund is generally trading in much more shorter time frames, and they're much more like traders. And then the traders that are trading for the prop fund are generally on what's known as a direct drive. So they'll get a specific percentage of the profits. So it's really almost completely different. There's no clients in a prop fund. There's basically just traders trading somebody's money. And then a hedge fund, there's clients that are expecting the hedge fund managers to execute a strategy as, described in their OM offering memorandum.
Yeah.
Hope that it helps.
Basically, hedge funds are pools of other people's money, while prop funds tend to be concentrated to like one source of capital.
Yeah. So listen, I went to one in New York when I was in New York, and this fellow reached out, and I went, and it literally was uptown. I went, and there's the 25 to 35-year-old kids sitting around. And, they had their dog there and everything, and it was just a bunch of them just banging stocks back and forth. It really was just like a room full of traders just banging stocks back and forth. And that's what most prop firms look like.
Yeah.
Now, the reason it gets confusing, Patrick, one last thing, is that sometimes hedge funds will have strategies within the hedge fund that resemble the prop fund. Meaning that you'll have somebody that does those kinds of trades and will have carved off a bit of money. But more and more hedge funds are completely different, and they're much more longer term in focus, and they're trading other people's money. And that's really where the differentiation comes. Okay, what do we got, Lena?
All right.
The last question of today's episode. Sorry I haven't submitted a question in a while. This is our friend Nick. He's submitted a couple of questions in the past. I've been busy listening to the Inside Baseball with Old Chestnut. Great podcast. That's with Morris.
Morris, yeah.
My favorite part is when Morris talks about how much he loves Kevin. I can see Kevin listening to Old Chestnut while he's checking Sunday Night Futures. When he gets a mention, he lets out a little schoolgirl giggle and rewinds maybe 3 to 5 times. The question...
I would imagine that too.
Kev, in conversations with Morris, have you ever slipped up and accidentally called Morris Dad?
Have you?
No. Listen, Morris is such a great guy. He's very kind, and he says very nice things about me. And I always joke and say that I wish that we had met earlier, because often when we talk about trading things, we're on the same wavelength, and the type of trading we do and how we think about things is so similar. And I think Morris has said this. He says we would have made a lot of money together, and I really do. It's probably one of my great regrets in life that I didn't get a chance to go trade with Morris. I'm very appreciative of everything that he's done, and the fact that he keeps talking about me is an honor.
Oh.
But I have not called him Dad.
You know he's listening to this too.
No, he doesn't listen. Are you kidding? He does not listen. There's not a chance he listens.
Oh, well, you know what? He's about to watch the YouTube feed. He's going to come in. He's going to mention that he heard this. All right. So now, Lena, where can people submit their questions?
So if you like the answers that we have given today, please submit
Very
your
small
questions
chance,
to nostupidquestions@markethuddle.com.
All right.
Okay, so thanks for tuning into the Market Huddle. We appreciate you all for spending time with us. Please give us a follow at the Market Huddle on Twitter. Lena's there. She gets tired of talking to Patrick and myself. You can listen to the Market Huddle on all the networks: Google Podcasts, Podbean, Spotify, Android Play, iTunes, and YouTube. A lot of people watch on YouTube to see all of our charts and visuals. And while you're there, please like and subscribe to get our latest content. And, you know, I'm going to stick with my new tradition. Instead of asking you to review, I'm going to read a couple of reviews. Here's a couple for us, Patrick. Okay. Eric M2285, which, by the way, I've noticed the kids, have you gone on Twitter and you see these, you know, like Kevin 7272154 or 2789?
I've seen that before.
And I'm like, what are these, Russian bots? But I think it's like what the cool kids do these days. Anyways, Eric.
They choose digits.
They choose digits, like random digits.
I
Or
think
is that like their phone number?
No, I think when you try to sign up, sometimes they just spit out that random digits at the end because there's so many people using that same name or whatever.
And they just want to be the cool kids.
I think
I'll take the digits.
Anyways, Eric, he says, love the podcast. You guys are hilarious and brilliant. He's obviously listening to another podcast. My one complaint is you're both Canadian, so you sound exactly the same. I cannot tell Kevin from Patrick, but who cares? 5 stars.
That's good because I sound smarter when everyone thinks it's me.
So
talking.
listen, I have to tell people something. My father has trouble telling us apart.
Yeah, but you sound like the guy from what is the Family Guy? What's
No. I sound like Olaf from Frozen.
Is that what it is?
Yeah.
And that means I sound like Olaf.
No, because
we sound alike.
I guess you do, but
I
not
can
as
tell
much
you
as
guys
me.
apart.
I can too. Like now, it's like every now and then I do see it, and like there's no doubt that we have some Canadianisms, no doubt. But
Z or Z, which one is it?
I was so sad when Jamie, we had him on and he started talking about BUZZ. I was like, what? And then
what are
I
you
was
talking
listening
about. He's Canadian.
I know. I gave him shit. And then I was listening to Jonathan Farrow on Bloomberg TV, who's a British guy, and he said Z as well. And I was like, oh, they've got you too. Like it's too late for him.
Got him.
No, got him. He's a professional. He has to do the professional thing. But Jesus, Jamie's not a professional. Okay, one more. Richie Lafleur, which, speaking of Canadian, Richie Lafleur,
is about as Canadian name as you
for
get.
sure. Okay. Now, listen, this is Richie's view, not mine. Okay. But I have to read it because it's too funny. Nice work. I've tried other podcasts, but Kevin and Patrick are better than anyone like that moron, Keith McCullough from Hedge. Keith is a hypocrite macro tourist. He likes to use it as an insult for other people. Kevin embraces it. Great work. Now, listen. Richie's opinion of Keith is Richie's alone. The only reason I bring this up is because I do embrace my macro tourism. And I do say, I just want to repeat, everyone, they know all I bring to the party is 25 years of mistakes. But I'm a little bit like...
But you've been trading for 35.
Exactly. I'm a little bit like, when your mom stayed 29 for years and years and years and you couldn't figure out why.
Exactly.
Yeah, so I am like that. But yeah, no.
You're at the denial age.
I'm the denialist age. So we love Keith. He's a fellow Canadian, but he definitely uses macro tours as an insult. I do not. I embrace it. And that is all you're going to get is errors from me. And there are lots of them, and I will tell you about them. Anyways, listen. Patrick, where can they find you?
You can find me on Twitter at Patrick Ceresna or follow me at bigpicturetrading.com. And Kev, where can they subscribe to your amazing newsletter?
Oh, God, Patrick, you're so kind. I'm on Twitter at Kevin Muir, and you can go check out my newsletter at themacrotourist.com. I keep trying to put the Substack. Anyways, listen, we can never have too many friends. Bear market, bull market. We're just happy to spend some time together on this crazy ride. So thanks for tuning in. Now stick around for the after show.
All right,
Okay.
Time to rate this beer.
This thing is terrible. I had
And
no
you
Yeah,
yourself
idea.
a
and you know what?
tall
You
boy.
should feel shame. This is first of all, there was no one that brought this in as a sponsor. This is you.
I know.
You are guilty
I know.
as
We
charged.
were stuck without
Like,
a sponsor.
no,
and Patrick
so-
sent me out, and he's like, "Okay, go get some beers," and I was like, "Okay, whatever." And I picked this, and I
Okay, but so we lost half of the respective half of our listener base when we had the pineapple sour. And then you go here and you do this PBR, and now we lost the respect of the other half of the listeners that we didn't respect, and
Yeah.
so now no one respects us.
Well, that's not unusual, but this is really bad. Like I didn't expect it to be this bad. How did you guys drink this, Lena?
I actually had 3 cans.
What do you mean? Have you not had this beer before?
Well, I think so I'm not sure, but I'm pretty sure. That's terrible English.
This is a ballpark.
Anyways,
This
listen.
is- if I was sitting at a
when I
baseball
was
game,
21 years old or something, 22 years old, I went down to New Hampshire to climb and ski this thing called Tuckerman's Ravine. Okay,
Right.
And I went with this guy we were bond messengers in the day. Like we were actually no, you know what? I was way less than 21 years old. He was 21. I was still in high school. So we went down there and we took our stuff and we decided to climb up this mountain and you sleep on the mountain and then you ski, right? And we were like, okay, we got to bring a lot of beer. And so we both brought 24 beers each because it was like going to be a weekend, right? And we bought Paps. And the problem was that it was a tough mountain to climb, especially with a case of beer on your back. So some people would just have left the beer. We didn't feel that was correct. So how did we solve it? We basically drank, the whole way up on the mountain. So we couldn't ski the first day. But I remember him telling us that, saying to us that Pabst Blue Ribbon isn't a beer, it's a diuretic. And I haven't had that problem yet, but it kind of tastes like one.
oh my God, I
Anyways.
can't believe it. All right, let's rate it. Okay.
We're gonna rate.
Kev, you start because you're going to set
I'm
the
going to
lower
give it like
standard.
a 5.2. It's terrible.
It's not terrible.
All right, Lena, you're next.
This
He
is-
gave 5.2.
This is nostalgic for me. I'm giving it 8.7.
Yeah.
What?
Lena's always on
Oh
the edge.
my
She's
I used
nice.
to drink this all
No,
the time
that
in
is
my 20s.
that is unsportsmanlike.
Okay, what do
like,
you
to
think,
go that
Patrick?
high? No, I'm gonna give it like a 6.
But you've had 3
Point,
of
no,
them.
amateur score. I'm gonna stick with the amateur score.
Yeah,
I'm not
you
even
got
gonna give it a
you
dot
said
zero.
You said it already. You can't go back.
6. Not even a dot zero. I'm just gonna say 6. You know what? This is a beer that like I said, this is what you would drink if you went to a baseball game and you have a bag full of peanuts and you're watching a game and you're just drinking beers. Like this is exactly what I picture.
It's not good.
No, it's not.
Oh, well,
good.
listen, I'm super excited about the Coors Banquet. I couldn't find it. I want to try the Coors Banquet and the Cobra Kai. A little obsessed with it. Did I tell you how I'm obsessed with the show?
Yes.
Yeah.
you have.
So I won't bore you again with it, but Cobra Kai. Speaking of shows, Lena, do you have any new shows for us?
I watched a couple of different shows this week. One of them is Love, Death, and Robots on Netflix. It's animated, short film, like animated. Like they're like 5 to 10 minutes long each, and some of these episodes have crazy animation. Like I couldn't believe my eyes. I was like, is this a real person or is this an animated, CG, whatever the technical term is for that? It's really interesting if you're into, kind of artsy sort of thing, then this may be for you. But like I said, it's really short, 5 to 10 minutes long. A lot of like existential, issues and robots and tech and things like that. So it makes you think a little bit. So it's kind of like an animated series of Black Mirror, if you've ever watched Black Mirror.
Yeah.
Okay, what else did you watch? Because that does not sound like something that Patrick and I are gonna
I
like.
watched The Sinner.
The Sinner. Wait, that's old.
It's an old, I don't know, there's 3 seasons of it. I watched it all in like a span of a couple weeks.
Is it good?
It's got Bill Pullman in it, and every season he's like a detective in all 3 seasons, and it's a different case each season. I thought it was interesting since I'm big into murder and crimes.
Yes,
Nice.
we know that.
But you know what? I'm going to change the topic.
Okay.
Lena's coming down to the Huddle piss up.
Yeah.
Or that's not piss up. I'm sorry for calling it
You
that.
gotta
No, the
stop
Huddle
it.
Muddle.
You gotta go everyone confused.
Lena, we're gonna have a great time down in Miami.
Yeah, and then I just realized, wait a minute, it's on Friday night, so I'm gonna have to.
Yeah, the show. We're gonna have to.
We're gonna have to figure something out.
Everyone needs to know that the show release date on the Saturday morning may be compromised on the on.
We're just calling it
on
right
June
now
12th.
as it is. We're compromised. It might
You want
be
me
a
to
Sunday
confirm
release.
model? It's gonna
It might
come
be a
out
Sunday
little
release.
It's going to get ugly. No, but we're gonna try pre-record parts of it, and I don't know.
What date is that? What date is that?
And it's the 11th and 12th of June. But we're gonna.
Did I go?
We're
and
gonna.
book a
By the
second
way, we're
guest?
gonna delay. We're gonna delay Cuppy's corner, which is normally the first week of the month. We're gonna do it after me and him mess around on the 11th, and then we're gonna record. It'll be a lot more fun that way. And so we'll do a little Cuppy's corner, but we're gonna try to get. We'll see. I think we can do it, right, Lena? I think we can get the show out on Saturday at some point.
We'll see. We'll see.
We'll see.
Depending
Don't
on how
commit
much
to it.
beer's there.
Don't commit.
Yeah.
It does start.
I'm speaking for Lena, like I'm about to do something.
Yeah,
It's
like
stop
that.
mansplaining to people.
Yeah.
I saw the greatest Twitter thread of mansplaining that I've ever seen. It was literally like people that, like the women, that would give examples of it. And there'd be like these PhD women that would have written the book and come up with the theory. And then some guy will explain it to them. I was just like, oh my God, like this is so awesome in terms of like how bad this guy is. Like you can't get any better than that in terms of mansplaining.
Yeah. Mansplaining.
Yeah, it's a pretty funny line actually.
All right.
Even my son does it.
What do you mean? What do you mean?
Well, like I think it's like something genetic. Like it happens.
Oh, you
like
mean he
at
does it to like his
like
friends
even at
or
a young
whatever?
age. Like he's just like it's like something happens. You just
Wow,
kind
wow,
of turn
wow.
into like you're a man. You're gonna be like, okay, you think you know better than everyone else. Doesn't matter that you're.
I've
14
never
years
done
old.
that. Never done that.
It's that good line about Mark Twain. It says something like, "When I left for college, my dad was a complete idiot. He didn't know anything. And then when I got back after, I came back at 25, I was shocked at how much he had learned."
Oh, that's the best.
Oh,
Yeah.
interesting.
So what's your big plan for the long weekend? Is anyone doing anything exciting?
Well, yeah, I'm going to be in New York, buddy.
Oh, you're going? Like you're
I'm the next Huddle on Friday. I'm going to be recording from Manhattan.
Oh no, we're talking about this long weekend, Canadian long weekend.
Yeah.
the Canadian long weekend. No. Yeah, you're right.
That's next
I'm
weekend.
mixing it up. I'm going to be Memorial Day weekend.
We're
I'm gonna
still
be,
technically locked down, right? Like what happened today?
I don't know.
I don't know.
I have no idea.
I think something happened. I think because
I feel like
the
they
boys
were-
on my trading desk were talking about golfing. So
They were releasing
You know what?
information about reopening. I think
nothing
but
changes
I
for
don't
me.
think there's anything different.
I was going to do what I was going to do anyway, so nothing changes. But yeah, it'll be good. It'll be good. Next week on Friday when we're recording the next Huddle, I'm going to be in Manhattan. It'll be awesome.
you're going to be on the town. Okay,
I'm
well,
gonna be on.
doesn't sound like we have much to talk about. So I think we're going to call it, quits.
Yeah.
It's a long
Very,
weekend. It's
very
hot.
poor after show. Very poor show.
Yeah,
You guys think about
we
this.
failed. We
You
failed.
guys go home and
This is what happens to Canadians when it gets hot outside. 'Cause it
That
doesn't
is
get
true.
hot.
Actually,
It's
it was
very
beautiful
hot
today, and I was sitting in my basement all day.
Yeah, we're
Yeah.
thinking about going to have some more brewskis outside. All right.
Yeah, well,
Exactly.
hopefully they're
Done.
not PBRs. Okay, listen, everyone. Thanks for tuning in. We'll see everyone next week. Thank you, guys. Thank you, Lena.
Thanks,
you, Patrick.
everyone.
Have a
Have a
great
great weekend,
Okay,
everyone.
bye-bye.
All right, cheers.